Good evening, ladies and gentlemen. My name is David Thoreau. I'm the president of the Independent Institute, and I'm delighted to welcome you to our special event this evening. As some of you may know, we put on a series of lectures and discussions and debates called the Independent Policy Forum. Some of you have been to some of these in the past, and for those of you who have not, we are delighted to have you come to our program tonight here in Oakland. We're quite delighted, by the way, to welcome back our dear friend, George Gilder. George is really a living legend and a dear person, and we've all, at least I know, I've learned a great deal from him. I'm very grateful for the work that he does and that he's here with us tonight. For those of you who are new with Independent Institute, this is a public policy research institute. What's different about us is that we're a scholarly public policy research institute. We don't dwell on the academic work per se. We're interested in communicating that to wide audiences. We're interested in advancing peaceful, prosperous, and free societies grounded in a commitment to human worth and dignity. And George certainly is someone who has exemplified that in his work. So for tonight, the first question that could be asked is, can the American jobs machine of economic growth and opportunity be continued? Can it be restarted? Can parents once again have confidence that their children will enjoy a standard of living higher than their own? Drawing on his new book, which is the topic for tonight, is The Scandal of Money. It just came out. Our guest will be here to address these questions and others. Incidentally, the title of his article in the Chronicle is called The Unicorn Economy. If you don't know what that is, I recommend that you pay attention to George tonight. George is a member of the Institute's Board of Advisors. He's actually one of the founding members of the Board of Advisors. He's chairman of the George Gilder Fund Management. He's host of Gilder Telecosm Forum. He's a fellow of the International Engineering Consortium. He's also a senior fellow at the Discovery Institute that he was involved in being a co-founder of. He's the author of many books. His most famous probably is Wealth and Poverty, which really created the entire supply-side revolution of tax reduction and opportunity. But other books include The Spirit of Enterprise, Microcosm, Telecosm, The Silicon Eye, Men in Marriage, The Visible Man, and many others. He pioneered the formulation of supply-side economics when he was chairman of the Lehrman Institute's Economic Roundtable, and he's been a fellow of the Kennedy School of Politics at Harvard. He's been a program director at the Manhattan Institute and a regular contributor to the Wall Street Journal and other influential publications. He's been a consultant to leaders of America's highest technology companies for decades, and he's a recipient of the White House Award for Entrepreneurial Excellence. One last thing I was going to mention is in the packet also there's some information about our journal. And this particular issue, which is the just prior issue, the cover article is on cryptocurrency, which relates to George's talk. So without further ado, I'm very pleased to introduce George Gilder.
Well, thank you, David. I'm thrilled to be among all these lighthouses. I mean, David himself is a lighthouse. The Independent Institute is a lighthouse, and my friends from previous lives are gathered here. Nick Tredenick, who is a lighthouse who designed the 68,000, the major successful Motorola microprocessor. It was really better than the 8086 and all those Intel. But in the spirit of enterprise, I tell that story a bit. And then Russell Redenbaugh is here, and he's a great philosopher of finance, but he's a lot more than that. And if you haven't heard his TED speech, which makes you throw up your hands and run out into the road and exhilarated excitement about being engaged in the world, you should see it. And Ron Baker, who is a friend who I've quoted and I think a couple books at least. He's revitalizing the whole philosophy of accounting. Anyway, it's great to be here. And I want to address the question of how you know when a paradigm dies. Now, I'm an author of a bunch of paradigms, but how do you know when it dies? And I think it's about time for the Keynesian paradigm to die. And how do you know, though, when it dies? I mean, its basic assumption is that exerting power over money and spending, central banks and governments can control economic growth, can summon economic growth. And the last few weeks have offered a few signals of a dying paradigm, if you didn't need earlier signals hadn't sufficed for you. The CBO had to estimate economic growth for 2016 by $1.6 trillion. This is revising further projections just 2 years ago. And the International Monetary Fund revised its estimates of economic growth for 2015 and 2016 by $18 trillion. And what? Down. Yeah, yeah, right. Yeah, all this is, and the world economic growth by 18 trillion. The current global GDP is about $78 trillion, and assuming that all the money creation and expanded fiscal stimulus being conducted around the world would produce substantial new growth, they overestimated the world economy by $18 trillion. Oops. And you might think that there really hasn't been enough of a test of Keynesian economics and monetary stimulus. Paul Krugman thinks that all the banks are much too modest in their efforts, but the assumption that lowering interest rates and expanding money has been substantially tested recently. We've had 600, according to the Bank of America economists, we've had across the world 619 interest rate reductions since 2008, 619, and $9 trillion of government debt issued with negative interest rates, and 10 trillion of quantitative easing, and U.S. Fed balance sheet has increased from 500 billion to 4.5 trillion. The Chinese balance sheet has similarly expanded, but that's another question. But this is a paradigm that's in trouble, and yet it can't really be displaced without an alternative paradigm. And I'd like to offer an alternative paradigm this evening. And the key to it is to understand that capitalism is not chiefly an incentive system. Now, this might seem like a provocative thing to say here at the Independent Institute, where this marvelous magazine, where I recommend all of you read the article about will cryptocurrencies take over. It's by Harwood, what's his name? Cameron Hawley or something. Anyway, he's a really smart guy, and Cameron Harwick. And it's an excellent explanation of cryptocurrencies, their potential, and what he believes to be their limitations, although I have some questions about his questions. But anyway, the key to understand is that capitalism is not chiefly an incentive system. And all the economic models, left and right, assume that economies are governed by homo economicus, they're by carrots and sticks, rewards and punishments, stimulus and response. And there's some psychiatrists in the audience here, I know. And the stimulus and response Skinner box model did not prevail in psychology, but it persists in economics. And the assumption is that human beings are just tools of outside incentives. And I think this is a mistake. And I think the nature of the mistake is suggested by the lighthouse. And the lighthouse is not an instrument of power chiefly. I mean, it does work with incentives, but its chief role is as a communicator of information. And the economy is really governed not chiefly by incentives, but by information. And this is a crucial insight for a new paradigm that can replace this failed paradigm of today. An information model gives us a new way to see wealth. And I believe that wealth is essentially knowledge. And you can understand this. A brilliant young economist at MIT, of all places, has named Cesar Hidalgo. You should look him up for the Independent Review. Has written a book called Why Information Grows. And he says that when an expensive car crashes against a wall, all its value disappears, even though every atom and molecule remains. Value is information. The car is knowledge. And I think if you can say that a car is knowledge, you can say that wealth is knowledge. And Thomas Sowell had a nice aperçu in his book, Knowledge and Decisions, written some 46 years ago, I think, something like that. And he said, the Neanderthal in his cave had all the material resources that we have today. The difference between our age and the Stone Age is the growth of knowledge. Well, understanding that wealth is knowledge gives us a new way to understand economic growth that's different from this Keynesian model that has been coming a cropper. And if wealth is knowledge, growth is learning. Growth is learning. And this insight came to me quite readily because I've spent years writing about learning curves and the ultimate learning curve of Moore's law that we see around here, and which is another learning curve. The learning curve ordains that with every doubling of total units, costs drop between 20 and 30%. And this insight has been central to the success of the Boston Consulting Group and Bain and Company and lots of business consultancies. But I think it's a profound insight of capitalist economics that learning curves dominate successful and growing economies. And the Boston Consulting Group and Bain and Company have computed learning curves for literally thousands of different goods and services, from insurance policies to microchips to transistors to software code to poultry eggs, and they just everything. You find a learning curve, and a friend of mine, Michael Rothschild, calculated a learning curve for rainforest slime molds, and he also calculated with very elaborate mathematics that I don't want to bore you with, that the learning curve for rainforest slime molds is much more advanced than the learning curve for public sector unions that don't understand the basic principle of not eating your host. So anyway, that's so understanding that growth is learning is an important point. And then learning is a real process. Learning isn't some arbitrary matter of multiplying money or expanding fiscal stimulus or something. Learning is something that real people do to increase wealth. And it's governed by the Popperian principle of falsifiability. Unless a business proposition can fail, unless it is subject to bankruptcy and failure, it can't advance learning. And thus, when the government guarantees businesses or guarantees the economy or guarantees incomes or whatever, by that very process, it stifles the learning that constitutes economic growth. So when that's a crucial way of understanding why money manipulation can't create economic growth. Because money is a lighthouse. It's an source of information about economic conditions that conveyed through prices and interest rates and all, which is a price of time and money. And so that's why we want, that's a crucial part of the paradigm. So wealth is knowledge, growth is learning. What is money? Well, I've been struggling with this issue for a long time. And one of the first ways I came to understand it a bit was money is a measuring stick. And I've writing about business and technology, I understand the significance of measuring sticks. I mean, in my book, I talk about the Système International in Paris, where they root all the basic metrics of the world economy in physical constants. And there's the second, the kilogram, the lumen, the ampere, there's a whole of the mole. There's 7 or 8 of them that are absolutely crucial, the meter. And they seem to be all different things: masses, distances, light emissions, various measures. But when you examine the physical constants that they use to root them in unchangeable reality, so that the same measuring stick will apply to a wafer fab in Santa Clara that applies to one in Taiwan or one in Bangalore. You get an idea of how crucial it is that measuring sticks be stable and transferable across economies. You can't have trade unless you have similar measuring sticks. Well, money is a measuring stick. That's one point. But what I found about all these other measuring sticks is they're ultimately rooted in time. The meter is measured by an emission of cadmium, and all the various measuring sticks, when you actually scrutinize the various procedures that govern them in the Système International, all have an electromagnetic radiance measured by the second, or they all, even masses, ultimately are rooted in the speed of light. Time is really fundamental to all physical measuring sticks. And I believe that money is most essentially the way time is manifested in the economy. Time is what remains scarce when everything else grows abundant. All these learning curves of capitalism with their deflationary impact. I think this idea that deflation is the ultimate catastrophe for an economy only applies to a Keynesian economy full of currency manipulators. In general, in Silicon Valley, you do pretty well reducing prices radically every couple years. And this is the learning curves that really create all value and growth. And they are in character intrinsically deflationary. So this idea that the goal of monetary policy is to engineer 2% inflation a year, which is what our current central bank and central banks around the world, including the European Central Bank, and are all aiming at a certain level of inflation. And the purpose of that is to make possible an ultimate descent into negative interest rates. And I think this may be the terminal crisis of the paradigm, because there are two major proposals that are being made by leading economists like Krugman and Ken Rogoff of Harvard and Larry Summers. These are leading exponents of the Keynesian paradigm. Now believe that it's necessary to have negative interest rates. And in order to have negative interest rates, you've got to abolish cash. Because if you're going to be filching people's savings without even enacting a tax, you're going to have to abolish the alternative of holding cash, which has a now attractive zero interest rate. So this is this is an end of the paradigm. I think abolition of cash and negative interest rates are measures sufficiently extreme to convey to the public that this current management of the economy is no longer viable. It's a paradigm that's died. But the other part of the paradigm is quite fundamental and is upheld really by economists all across the political spectrum. And it is that low interest rates spur economic growth and expansion. That if you, and this insight comes from the incentive model of the economy. Lower interest rates and means investment and is cheaper and spending is easier, and so it's an incentive model of the economy would convey that lower interest rates speed economic growth. Well, I've been talking about this with Jim Grant, who's author of The Interest Rate Observer. And he says that, that he really upholds an information role of interest rates. And what information an interest rate conveys is the average expected returns of investments across the economy. And thus, it represents the opportunity cost of spending now. And when you enact a zero interest rate, you're really saying there is zero opportunity cost. There's zero expected average yield for investments across the economy. You're conveying a signal that the economy is grinding to a halt. And I've been sort of perplexed by this. Grant's view is that interest rates function as a clock. They're the time value of money. I say the money value of time. And interest rates function like a shot clock in basketball. The ticking of the interest rate forces entrepreneurs to shoot. Rather than just continue passing the ball around and keeping everything, all possibilities alive as long as possible, which is free if money is free. So you throw away the shot clock and everything slows down. So lower interest rates don't spur the economy, they slow the economy down. They not only transfer a signal to entrepreneurs that they don't have to act, but they also convey the information that opportunities across the economy have collapsed, that there's zero return to investment. You might as well spend now, and that's really what the increasingly what I call the alibi economists who are coming forth to offer explanations and alibis for the failure of the Keynesian and monetarist models are now blaming entrepreneurs. Larry Summers and Robert Gordon, a great economist of productivity, brilliant, interesting tome he's written, but ultimately he believes that the reason the economy has come to that interest rates have reached zero and productivity growth has reached zero, that this convergence of zeros signifies a failure of the entrepreneurial economy. The technology prospects have dimmed, and new technologies no longer impart the same spur of economic growth that previous technologies did. And so this is alibi economics, blaming the entrepreneurs for the depression that was really largely caused by brilliant economists. So, but when you think about it, the Fed, I'm not one who, want to end the Fed and stomp on it or whatever, which is quite a widespread view. But I think a lender of last resort, demonstrably, if you look through the history of capitalism, has always been needed. And I think that abolition of the Fed isn't the point. And the Fed has, but the Fed has grown into a fourth branch of government. It's a regulatory monster. It now finances this runaway consumer finance investigation board, the Elizabeth Warren monster. And but anyway, the Fed is kind of nationalizing the economy by its intense regulation of banks, and so it's really so I don't think. But the Fed can control short-term interest rates to some degree because with the discount window and its open market operations can handle short-term interest rates. But when long-term interest rates affirm these almost zero rates, it signals that something is drastically wrong with the economy that money can't palliate. It signifies that there really is something fundamental going on that stifles investment opportunities. And I believe, and the message of the scandal of money is the crux of it, is that money is no longer a measuring stick. It's become a magic wand for government. And if money isn't a measuring stick, then entrepreneurs have no lighthouse. They have no way to know what real prices are, and trade shrinks. And so I believe that it's critical to create new forms of money that actually partake of this fundamental physical constant of the universe, which is time. And gold has been a great success throughout history. Gold, the time to extract gold from the ground has scarcely changed in centuries because as the technology of mining advances, the gold has become more difficult to extract from deeper lodes and more attenuated deposits. And so gold has been by happenstance a kind of time signal. And that's why it's been so important as money. And Satoshi Nakamoto, and whoever he may be, probably this Craig Wright guy in Australia, at least had something to do with it, according to people high in the Bitcoin movement. And Craig claims to be Satoshi. But anyway, Satoshi started with an effort to mimic gold, to incorporate this time governor into the production of money. And so Bitcoin attempts to mimic gold. And I believe that the future will come from the evolution of digital currencies, the popularization of the Bitcoin blockchain, the return of gold, which never went away. It's still the second largest reserve currency by some measures, and is increasingly sought and avidly by the Chinese, who, contrary to what you may hear, are not particularly monetary manipulators. They actually refuse to float their currency, and thus refuse to partake in the scandal of money that's epitomized by the alternative to gold. And whenever anybody tells you all the terrible perils of gold, and which can be addressed by human intelligence. It's not a automaton, but anyone who tells you the perils of gold should contemplate the alternative, which is floating currencies. And floating currencies today, the last accounting of the Bureau of International Settlements and 3 years ago shows that currency trading is $5.3 trillion a day. And $5.3 trillion is 26 times all a day, 26 times all global GDP, 73 times all global trade in goods and services. It does not even arrive at currency values that are more stable than the economic activity that they're supposed to measure. And 98% of the currency trading is speculation, and it's 77% of it's conducted by just 10 big banks that have all been deemed by Dodd-Frank as too big to fail, and they sort of dominate this huge wilderness of currency trading that is a hypertrophy of finance, and I think an ultimate scandal of money that we got to get beyond. Thank you very much.
Hello. I'm very impressed and very educated by your books. And my question is if I understand the situation correctly, would someone say that our present predicament is a natural and unavoidable transition of the American economy from an industrialized, making automobiles and things, to a information society where we make services and such? Was that an unavoidable transition, and that's what got us to this position?
Good question. I don't actually believe that information theory is limited to the information economy. I think the entire economy, as I said, automobiles are knowledge. So I don't think this has anything to do with the supposed change of us from industrial to an information economy. I think the industrial economy was fundamentally an information economy too. I also don't believe that there's any fundamental change signified by AI or robotics or any of these very impressive advances that are being produced today. I think they represent a continuation of a trajectory of technological advance that has proceeded for hundreds of years, essentially since the beginning of the 19th century. And so I think that no, this is not, the alibi is not that we're moving to a new economy. Marxists have been saying that we're moving to a new economy and this obsoletes capitalism, and I don't have any patience with that idea.
I'm really struck with the fusion you're producing between information theory and the theory of money. As you know, I've worked in that area most of my life. And I'm struck with what Nassim Taleb writes in Anti-Fragile. Yeah. He says trial and error, tinkering is information. Yeah. Failing is information, success is information, and only from those informations do you make the innovations that we're famous for. Yeah. And you really rang the bell for me, George, when you said if you eliminate the chance for failure, you end the chance for learning.
Yeah, pretty much.
Well, I think our education system's demonstrating this. All kids have attended, all must have grades, all must have self-esteem. So anyway, thank you.
Well,
It's a
thank you.
wonderful book,
That's-
George.
that's
I think this
great-
will be your most impactful book.
Well, thank you. And
Thank you, George. In a section of your book, you described how the measurement of time in our currency has essentially failed, and it has spurred this overinvestment in assets like real estate. Could you talk a little bit more about that and the phenomenon of essentially discounting the scarcity of time has misappropriated a lot of investment in assets like real estate?
good question. This is a theme that what we've this hypertrophy of finance that's epitomized by the 5.3 trillion a day. There are new estimates coming out shortly from the BIS, and I gather that they're going to be a little lower now, that the slowdown of the world economy has even affected the currency trading side, but it's not a big change. But anyway, that the bifurcation is really finance, and with free money manages to transcend and escape time. I mean, imagine the Flash Boys trading in milliseconds. This isn't capitalist trading in any plausible sense. This is an effort to attain escape velocity and transcend the constraints of time and space in the economy. And so we have a bifurcated economy, with one side fleeing off into this nirvana, timeless nirvana of free money, and the rest of us incarcerated in time, working by the hour and by the week, and unable to escape the usual constraints. And so what's really necessary and what can be achieved by creating a real money that can't be, that isn't part of what it measures. This is why Hayek, for all his genius, and I quote him repeatedly in my book, but the Austrians sort of believe that money is a commodity somehow. And money can't be part of what it measures, or it just becomes a self-referential element, that loop that like what we experience today. So establishing money rooted in time, which can't be hoarded, which can't be redistributed much, which is governed by the directionality of entropy, which is thus linked to information theory, is really the way to end the significant maldistribution of wealth that's been occurring around the world as a result of this hypertrophy of finance that I describe in The Scandal of Money.
Thank you, Mr. Gilder. Can you give us your viewpoint on whether we will see deflation, and I guess regardless of your viewpoint on that, what telltale signs we might want to look at to see if it does come in a year or 5 years or what have you?
Yeah, I think deflation is good, and so I think that, but there are forms of deflation which we see, which are essentially financial deflation, which can be destructive. But in general, capitalist economies ride learning curves of steadily reducing prices, rising values, that effectively mean that that deflation is the rule of capitalist growth. And William Nordhaus of Yale I did a chapter on Nordhaus's great paper on the 1000x mistake in economic growth made by economists who, during the 19th century and before, were, as part of the dismal science, failed to measure the learning curve in light, how many labor hours it took for an additional lumen of light. And all the time that the poets were writing about dark satanic mills and socialists were ranting about the treatment of labor, the fact was that a great luminosity was spreading around the world, and people could read at night. People could extend their days in many ways, and the ultimate error in measuring economic growth that was implied by his analysis, which he began with the cave fires of the cavemen and went through the billion candles or something at Versailles and through the whale oil and how fossil fuels saved the whales and the onset of electricity that brought another 1,000-fold advance in the cost effectiveness of luminosity of lighthouses and light. But if you would incorporate the Nordhaus numbers into your estimates of price levels during all these centuries, you see we've been in constant deflation. And most of the economists really live in a house of mirrors. The statistics of price levels and deflation and inflation are all pretty much delusional.
Thank you for this good talk. In your book, you have some gentle criticism of Milton Friedman and his advice to President Nixon. I recall at the time the Treasury was losing quite a lot of gold to France, and to the French of all people. And I'm wondering, what advice would you give Mr. Nixon?
Well, I think that the turning point in a turning point in history of economics is Nixon's departure from the gold standard in 1971. Counseled urgently by Milton Friedman, who imagined that the result of leaving the gold standard would be to stabilize the dollar price and result in a drop in the price of gold. And Milton is brilliant an economist who ever lived, and I describe my sort of debates with him bouncing through the streets of Shanghai in 1988 on a Cato Institute trip. And Milton had a terrible experience that traumatized him intellectually, and that was inflicted by the King of Sweden and awarding him the Nobel Prize for his two big mistakes, essentially. And one of them was monetarism, which he very belatedly reconsidered, and the other was the permanent income hypothesis that explained velocity, that explained why the velocity of money in his model could be a constant. And the velocity of money has to be a constant if MV equals PT. And control of M, which is what central banks exercise, suffices to control output. And the permanent income hypothesis says that our propensity to spend is a psychological propensity, derives and is part of the tendency to save when you're young and to spend when you're old, and it's a whole psychological model that was regarded as a great revelation to the economics profession, because it explained why you could trust velocity and thus control economies through governing the money supply, as Milton told the Chinese leaders, first thing to do is get control of your money supply. And I think it was a real blind spot in Milton. He was brilliant, and he understood everything, but somehow this particular idea gained dominance in his portfolio because of the Nobel Prize, I think. I think he would have abandoned it pretty quickly if it hadn't been kind of inflicted on him forcibly by the economic profession.
How do you convert a Keynesian?
You know, I think that you get them to really read Keynes, among other things. I mean, Keynes had a very subtle and fascinating mind and impressive writing style, and his general approach was to change his mind when the facts changed. And he's famous for asking what, I changed my mind when the facts change. What do you do? And I think Keynesians have to contemplate this collapse of their paradigm, and I think a lot of people can change their minds. You know, I've been through a lot of changes in my life, and I think more people are coming to terms with this current impasse than maybe evident on the surface.
What are the possible paths? So money is going to basically not be our measuring stick anymore. So creators are always going to create and find a way to trade. So what are the possible options of how you see this coming to be? And then, you know, as my mind's just thinking here as a random sample of what I see, a small group maybe as already trying to do it, but how does that get then proliferated to the population?
Yeah, well, I think that this change is going to happen. It's underway. The various lines of it include digital currencies and the Bitcoin blockchain, which is a fundamental advance in security technology that replaces the centralize and conceal model of security, which is really creates targets for hackers with huge payoff. And instead, a distributed security through publication and transparency model. So you have to capture all, you can't capture one data center, you got to capture all the computers in the Bitcoin system in order to reverse the blockchain since the Genesis block of Satoshi. So I think that one of the prospects is really the evolution of Bitcoin, I think, as a layer 8 for the internet, you know, a new layer in the internet software stack for trust and transactions that will transform the internet by micropayments and secure transactions that will allow content producers to collect their own revenues rather than depend on some advertising and aggregate an advertising model that I think is bankrupt. I mean, YouTube, we've been talking about YouTube, and does anybody really want to watch an ad before you watch your YouTube video? Do you ever really want to do it? I mean, here we have the most sophisticated company in the world, probably, is Google. And they've adopted this absolutely ludicrous model of YouTube advertising. It's constantly offending their customers at every point and destroying the advantage of the internet over the old television model. So anyway, that's one thing. Another thing is people really do withdraw from this non-monetary, this economy of debauched and manipulated money. And they, one of the phenomena that's pervasive across the world economy is underground transactions, as they're called. Edgar Feige has been writing about this since I was a kid. He must be old now, but he's going strong, and he calculates that some 36% of global transactions are now underground or unreported or whatever. And this is the kind of thing that happens when the actual official economy no longer functions, that the regulatory state extends its myriad tentacles across all our economic activity to the point that people just flee into off the books barter. And barter is very hard to accomplish, and it's not efficient, but it's better than, but when tax rates and regulatory intrusions reach a certain level, even barter is preferable to dealing with government power. So at least you got knowledge to exchange. And knowledge isn't illegal in barter. So this is so there's that, and local, and you know there are lots of ways people are rebelling against this apparatus, and I think on the global economy, lots of countries are seriously contemplating return to gold as a key element in international transactions. That if the Chinese face a real monetary collapse of some sort, you'll see them very readily move back to gold. They have, they mine more gold than anybody else now. They're accumulating large gold reserves, and they're quite ready. Their default position is to return to gold. And Robert Mundell is their favorite economist. You know, he's the founder of supply-side economics and an advocate of fixed currencies and an enthusiast for gold. And Mundell is a professor honorarius or something at 30 Chinese universities, and the name of the chief financial university in Beijing is the Robert Mundell School for Finance and Entrepreneurship. And you know, Mundell is, the Chinese are serious in their critique of American monetary policy. It's really funny when you hear people denounce the Chinese for manipulating currency. They actually understand why it's a mistake to manipulate currencies.
Do you think with the invention of new payment methods like Apple Pay, Bitcoin could potentially overtake government-backed currencies for transactions in like physical world?
I believe that Bitcoin will evolve through the expansion of internet transactions. That internet commerce is now about 6 or 7% of global commerce. And Bitcoin is a tiny proportion of internet commerce. So there's a long way to go before it takes things over. But it can, particularly if we elect people who are willing to remove the capital gains tax and other defenses of government monopoly money and allow Bitcoin type alternatives to emerge. And there are many interesting innovations in this area. I think that it's possible to have a very rapid change of mind around the world, perhaps led by China, and with various combinations of, see, I think gold and Bitcoin are the same thing. They're, effectively, they both are rooted in time, and they both, and gold, any new gold standard that emerges is going to be linked to blockchains and to all the new technologies of finance that you people of Silicon Valley are developing. And so, and the banks are even understanding the value of the blockchain now. You know, the big consortium is pursuing blockchain technology. They want to separate it from the Bitcoin currency. And I think that's a mistake. I think that ultimately the value comes in establishing a new currency. And contrary to this excellent article, Will Cryptocurrencies Take Over? I don't believe that the current volatility of the Bitcoin price signifies its inability, it's fundamental. And I think that, that as Bitcoin converges with gold, it will stabilize. It's a currency to the extent that it's accepted as a currency rather than as a speculation.
Thank you. George, I agree with you that Bitcoin is gold, but Bitcoin is not a central bank and can't manage the variability of demand for money.
No. It can't. I believe that as Bitcoin evolves, it will evolve like all monies. It's not going to be just a base currency alone, which is gold succeeded because it transcended being a base currency and had a form of fractional reserve banking attached to it so that investors and savers and their knowledge and intelligence was engaged in the process of using gold as money. And I think Bitcoin, too, it's already evolving side chains and other methods of incorporating essential forms of fractional.
But wasn't the Bank of England rather skillful in adding reserves at times of crises?
Well, most of the time, in times of crises, yes. But most of the time, in times of crisis, Britain did leave the gold standard. I mean, people, the gold standard is a hard master because it does convey a reality about economic conditions, and particularly in wars, it has been abandoned. This is why I think it's a mistake to, as some people pretend that you enact a gold standard and then you can forget about money. And I believe that it's necessary to have monetary institutions, lenders of last resort, and so I think that it's most important to the first step anyway, to have a central bank that understands money and doesn't think it's a magic wand anymore.
2 points on that point. If I remember correctly, during the great time of peace in the 1800s, when the Bank of England bailed out an institution, it did so at punitive rates to maintain discipline in the system. And secondly, the linkage that you just indicated, that gold is essentially a peaceful money and disciplines, I think, the world to peace.
Yeah. Well, I think that's those are good insights. That history in the early 18th century is one of my real discoveries that I'm proud of, and I think we must be.
Just one last question.
Is that what joins physics and gold is Newton. And Isaac Newton, I've read all the biographies of Isaac Newton, and they're all written by historians of science. And they all tell the story of how Isaac Newton had his grand synthesis and Principia and transformed all of physics for all human history, and then retired to the Bank of England, where he became first warden of the mint in 1696, and then master of the mint. And he was awarded the sinecure as a result of a beautiful niece he had, who was beloved of Lord Montague, and then Newton wasted his last 30 years doing alchemy and other degraded pseudosciences. And what I really discovered when I explored that history is that Newton really invented the gold standard. He was the one who established Britain on the gold standard. Until he took over, it was a mixture of silver and gold, and with bimetallism had obvious flaws because the prices diverged and there were various flaws. But Newton resolved on gold, and he, during his time, 30 years as master of the mint, he produced 25 times more gold coins than silver coins, and he was ferocious in making sure that gold couldn't be hacked, just like all the Bitcoin people worry about Bitcoin being hacked, and thus becoming just another vulnerable currency. Newton, as the leading nerd of his era, wanted to make sure that gold couldn't be hacked from mercury or lead or some inferior metal be transformed into gold. And so he tried to hack gold. But I think it's possible that Newton's greatest contribution was in his role as master of the mint. He was an absolute giant in physics, but there were other giants around him, and they were coming closer and closer to his revelation. And so I believe that his fanatical devotion to gold was what allowed the British to eclipse the previously superior traders in the Netherlands and replace the Gilder with the pound and pound sterling, and that this was Newton's greatest contribution, transformed history.
The issue of fractional banking came up, and that's part of the Eurodollar. And Milton Friedman wrote a paper about describing the Eurodollar. I'm wondering if you've considered fractional reserves and all the debt that surrounds it and the vast increases in the euro dollar as part of the disintegration of money in the world?
Well, I think certainly the Eurodollar did escape the controls of and the national economic model that was then entertained in Washington was confounded by the emergence of Eurodollars, which were in demand and needed to finance the expansion of commerce during that era. So I don't think that the Eurodollar was a negative development. I think it was a real development, and it happened before this vast hypertrophy of finance that we've been seeing in the recent era. And I think it shows that markets can accommodate money, even when governments try to suppress them, as Lyndon Johnson and Nixon tried to do. So I think having the real insight in this excellent article that I think you should read, Will Cryptocurrencies Take Over? It's quite profound, and it explains why Bitcoin can only be a successful currency if it does accommodate forms of fractional reserve banking. That this idea that Rothbard and others have entertained, that you can have just essentially base money without the monetary tinkering and discovery that investors and savers perform with it's the alchemy of finance, as I wrote years ago in Wealth and Poverty. And Mervyn King, the chief British central banker, has a book now called The Alchemy of Finance. And it's the same alchemy I identified in Wealth and Poverty. And it's the how banks, it's the role of real banks. They convert the desire for safety of savers, the cautions of savers, into the willingness to risk of investors. And that alchemy of finance is the crucial role of banks and the secret of the success of capitalism. And if you try to control everything, if you don't allow the alchemy to occur, you'll end up with a stagnant economy like we have today.
I want to thank George in particular for his many decades of devotion to these issues. And we hope that you'll join with us again. There's much on our website at independent.org. So thank you very much, and good night.